Okay, so we just got this major economic report that, on the surface, looks like absolutely fantastic news. Inflation seems to be cooling off way, way faster than anyone predicted. But if you look just a little bit closer, a really interesting mystery starts to pop up. And this is the number that got everyone talking: 2.7%. That was the annual inflation rate for November, according to the Bureau of Labor Statistics. Now, after the long, painful stretch of high inflation we've all been living through, a number like this is a massive shock to the system. And just to be clear, this wasn't just a little bit better than expected. We're talking about a huge miss. The experts, the ones polled by Dow Jones, they were calling for 3.1%. The actual number just blew that forecast out of the water. Even the core number, which, strips out the crazy food and energy prices, came in way lower than predicted. So this is it, right? This is the victory we've all been waiting for? Time to pop the champagne? Well, hold on, because almost as soon as this report dropped, the people who really understand this data, the real data nerds, started raising some pretty serious red flags. What's so wild is how this number was received. It basically split everyone right down the middle. It was this classic case of one group celebrating and another group getting really, really suspicious. So on one side, you've got Wall Street. They see low inflation and boom, they do what they do best. Stocks take off, bond yields drop. It was a party, basically. But then you have the economists, the folks who live and breathe this stuff, and they're just scratching their heads thinking, wait a second, something about this just doesn't add up. So why were the experts so skeptical? Well, the whole investigation, and it really is an investigation, starts with a huge disruption that happened right before this report was made: the government shutdown. Now, this wasn't just some political story. It had a direct and pretty messy impact on the data itself. And this timeline really shows you the problem perfectly. The shutdown literally forced the Bureau of Labor Statistics, the BLS, to just cancel their data collection for October. Gone. So imagine, you're trying to figure out November's numbers, but you have a giant black hole where October's data should be. You're flying blind, and that means you have to start making some, let's call them, unusual methodological choices. And economists like Michael Gapin over at Morgan Stanley, they spotted this right away. He basically said, look, with no October data, the BLS probably just carried forward some prices. Now, that's just a fancy way of saying they assumed zero inflation for some things. He called the whole report noisy, which is economists speak for, I wouldn't trust this as far as I could throw it. Okay, but here's where it gets really interesting. The investigators, and I'm only kind of kidding when I call them that, they quickly zeroed in on one specific detail inside this noisy report, what looks a lot like the smoking gun. And that clue is something called owner's equivalent rent, or OER. Now stick with me, it's a little weird, but it's super important. It's how the government tries to measure housing costs for people who own their homes. And the only thing you really need to know is that it is a huge piece of the overall inflation puzzle. So here's the bombshell. Analysts like Krishna Guha at Evercore ISI, they dug into the data, and they're pretty sure the BLS literally just plugged in zero inflation for multiple categories when they were calculating this OIR thing, especially for about a third of the cities they track. And you have to understand, this isn't just some tiny rounding error. We're talking about a massive part of the inflation index, housing. If you just decide that parts of it had zero price change because you're missing the data, you are absolutely going to drag the whole number down. You're creating this huge artificial downward bias. Okay, so we've got the shutdown, the missing data, this OER anomaly. Let's connect the dots. What's the final verdict here? What does this all actually mean for you? All right, let's lay out the case file one more time. First, you've got the canceled October data, which created a huge blind spot. Then you've got the very real possibility that key housing data was just flat out set to zero. And to top it all off, some people pointed out that the data was collected later in November than usual, so it probably picked up a lot more of those Black Friday and holiday sales. All of these things point in one direction. So what's the immediate fallout? Well, the Federal Reserve, the people who actually set interest rates based on this stuff, they're almost certainly going to look at this report and kind of shrug. One analyst put it perfectly: the Fed will almost certainly put less weight on this reading because they know it's just too messy. So the big takeaway here is that this good news, it's probably not real, at least not yet. What we're likely seeing is a temporary illusion, a downward dip caused by all these data problems. The consensus among the experts is that we should totally expect a bounce back in the next report as the data gets cleaned up and things get back to normal. And this whole affair just leaves you with a much bigger, more important question. We all see that one headline number, right? And we react. But if that number can be this flawed, this easily twisted by something like a government shutdown, it really makes you wonder, how do we know who or what to really trust?